What if I told you that most professional investors, the people paid millions to beat the market, actually lose to a simple strategy anyone can use? Not hedge funds, not Wall Street elites, not financial geniuses, but an idea so boring, so simple, that many people ignored it for decades. And yet today, this idea quietly controls trillions of dollars, shapes retirement accounts, and determines whether average people build wealth or fall behind. It's called an index fund. But here's the mystery. If index funds are so powerful, why aren't they taught properly in schools? Why do banks push complex products instead? And who tried to stop this idea from ever becoming popular? To understand that, we need to go back to a time when investing was designed to benefit only one group. Before index funds existed, the stock market was not built for regular people. In the early 1900s and even mid-1900s, investing was dominated by wealthy families, big institutions, brokerage firms, and fund managers who charged heavy fees. The average person had two choices: either trust a fund manager to pick winning stocks, or stay out of the market completely. And Wall Street sold a powerful promise: pay us fees, and we'll beat the market for you. This became the foundation of the modern investment industry. Thousands of mutual funds were created. Each claimed superior strategies. Each promised better returns. Each charged management fees. But almost nobody asked a dangerous question: what if most of them are wrong? And when someone finally did, the financial world laughed. In the 1970s, a quiet, stubborn man named John C. Bogle noticed something strange. He wasn't a billionaire trader. He wasn't a hedge fund celebrity. He was studying data. And what he discovered shocked him. When he analyzed decades of stock market performance, he realized most professional fund managers failed to outperform the overall market after fees. Even worse, the more actively managers traded, the worse their long-term performance became. Fees were silently killing investor returns. Trading costs were eating profits. Emotions were destroying strategies. So Bogle asked a radical question: if most investors can't beat the market, why not just own the entire market? This idea sounded crazy at the time, because the industry was built on complexity. Selling simplicity would destroy business models. But Bogle pushed forward anyway. In 1976, he launched something revolutionary: the first public index fund. And it was mocked. Financial magazines called it Bogle's folly. Experts said no one would invest in average performance. Banks refused to promote it. But what happened next changed investing forever. Let's slow down and explain it simply. An index fund is a fund that does not try to beat the market. Instead, it copies the market. For example, the S&P 500 index contains the 500 biggest companies in America. An S&P 500 index fund simply buys shares of all those companies: Apple, Microsoft, Google, Amazon, Tesla, and hundreds more. Instead of guessing winners, you own everything. This means no stock picking, no constant trading, very low fees, automatic diversification. You are betting on the long-term growth of the economy itself. And historically, that has been a powerful bet. Here's the brutal truth: Wall Street doesn't advertise. If the market grows at 10% per year, and your fund charges 2% in fees, you're not earning 10%, you're earning 8%. That small difference doesn't seem big, until time multiplies it. Over 30 years, that fee difference can steal hundreds of thousands of dollars from an average investor. Index funds changed this equation, because they require no expensive analysts, have minimal trading, use automation, charge extremely low fees. Some index funds charge less than 0.05% per year. That's almost nothing. And that single factor alone explains why index funds began outperforming most active managers. Not because they're smarter, because they're cheaper. At first, growth was slow. In the 1980s, index funds were considered boring. But then something unexpected happened. Data kept proving Bogle right. Study after study showed over 80% of active funds failed to beat the market long term. The few winners rarely repeated their success. Fees were the biggest performance killer. Large pension funds started switching. Then retirement accounts followed. Then individual investors joined. Today, index funds control tens of trillions of dollars globally. They are used by governments, universities, billionaires, everyday workers. Retirement funds, what was once mocked, became mainstream. But this success created new problems, and this is where the story gets darker. As index funds grew larger, critics raised serious concerns. One major fear: if everyone buys index funds, who is actually analyzing companies? Who decides which stocks deserve investment? Because index funds automatically buy companies based on index rules. Not performance, not ethics, not innovation, just size and inclusion. This created massive flows of money into the biggest corporations, making giants even bigger, giving enormous power to a few fund providers. Today, just 3 companies manage a massive percentage of global index assets. That concentration of influence raises questions about corporate control, voting power, market distortions. Financial stability index funds solved one problem, but may have created another, and we haven't even reached the biggest twist yet. A strategy once mocked, now controlling trillions, used by governments, billionaires, and retirement systems worldwide. But every financial revolution carries consequences. And now we arrive at the uncomfortable question: what happens when everyone uses the same strategy? Because the true test of index funds doesn't happen during good times. It happens during fear. It happens during crashes. It happens when markets bleed red, and history has already given us warnings. Let's rewind to 2008, the global financial crisis. Banks collapsed. Housing markets crashed. Stock markets fell over 50%. Index funds didn't protect investors from losses. They fell with the market. And that's something beginners often misunderstand. Index funds do not prevent losses. They guarantee one thing only: you get market performance, good or bad. If the market crashes 40%, your index fund crashes too. But here's the twist: most people who panic sell during crashes, lock in losses, miss the recovery, destroy long-term returns. Meanwhile, investors who stayed invested, who are covered faster than most active traders. Why? Because recoveries happen quickly, and index funds automatically benefit from rebounds. For example, after 2008, markets eventually reached new highs. After COVID crash in 2020, markets recovered within months. Those who stayed invested won. Those who panicked lost. Index funds don't fail during crashes. Human behavior fails. This is the hidden danger nobody explains. Index funds are simple, but simplicity creates overconfidence. People believe, I don't need to learn anything, I'll just buy and forget. But investing success isn't only about what you buy, it's about what you don't do. Don't panic sell, don't chase hype. Don't jump in and out, don't try to time the market. Most losses happen because people interfere emotionally. They sell low, they buy high, they repeat mistakes. Index funds work best for investors who understand patience, not for gamblers. As index funds gained popularity, the financial industry fought back. They created smart beta funds, factor funds, complex ETF strategies, trend-based products, all promising better than index funds, smarter than the market, lower risk with higher returns. But history repeated itself. Higher fees returned. Complexity increased. Performance often disappointed. The same old pattern. When simplicity wins, complexity tries to take back control, but data continues to favor low-cost index investing. Today's market shows repeating cycles. Retail investors chase meme stocks, crypto hype, AI bubbles, social media trends, while long-term index investors quietly compound wealth. Look at this pattern during every bull market. People abandon boring strategies. During every crash, they return to safety. The cycle never ends. And here's the shocking truth. Most millionaires were not created by lucky trades. They were built through long-term investing, consistent contributions, compound growth, patience. Index funds didn't make people rich overnight. They made people rich slowly. And slow wealth is invisible until it's massive. Now let's make this practical. If you're a beginner, here's how index fund investing works step by step. Step 1. Choose a broad market index. Examples include S&P 500 Total Stock Market Index, Global Market Index. These give instant diversification. Step 2. Use low-cost funds. Always check the expense ratio. Lower fees equals higher long-term returns. Step 3. Invest consistently. Monthly investing beats trying to time the market. This is called dollar cost averaging. Step 4. Stay invested. Long-term index funds reward time, not speed. The longer you stay invested, the more compounding works. Step 5. Rebalance. Occasionally this keeps your risk balanced as markets move. Simple steps, powerful results. Let's destroy one dangerous myth. Index funds are not risk-free. They carry market risk, economic risk, inflation risk, political risk, but they reduce company risk, stock picking risk, emotional risk, timing risk. They don't remove danger, they manage it intelligently, and that's the difference. Now let's bring everything together. Here are the 3 most important lessons every beginner must remember. The more complicated an investment sounds, the more likely someone is trying to sell you something. Index funds win because low fees, broad diversification, long-term focus, simple strategies quietly outperform flashy ones. You don't need to be smart. You don't need predictions. You need consistency and patience. Compounding rewards time in the market, not timing the market. Your biggest enemy isn't the market. It's panic, fear, greed. Discipline beats intelligence in investing. But here's the uncomfortable truth. Index funds won't save people who spend more than they earn, have no emergency fund, panic sell during crashes, chase quick money. Index funds are tools, not magic. They reward responsibility, not shortcuts. And as global debt rises, inflation pressures grow, and markets become more volatile, the next decade will test investor discipline harder than ever before. So the real question isn't, are index funds good? The real question is, are you disciplined enough to let them work? Because wealth isn't built by markets alone, it's built by behavior. If this video helped you understand index funds clearly, hit the like button. It helps more beginners find real financial education. Subscribe for more simple investing guides without hype or fake promises. And comment below. Are you already investing in index funds? Or are you just starting? Your answer might help someone else take their first step.